This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Jon Ferro and Lisa Abramowicz. Join us each day for insight from the best in economics, geopolitics, finance, and investment. Subscribe to Bloomberg Surveillance on Demand on Apple, Spotify, and anywhere you get your podcasts, and always on Bloomberg.com, the Bloomberg Terminal, and the Bloomberg Business app. A hugely popular guest, and I don't mean popular in terms of fun and games, I mean insight and intellect. Peter Tchir joins now, head of macro strategy at Academy Securities. Peter, you were on fire last time. It was just really brilliant about the dovetail of all these narratives. How has your narrative changed, say, in 10 days?
Well, we're all having to process what's going on with Israel, Hamas, and the Middle East. So that's probably been the biggest change. It's been clearly a very sensitive issue. We think it's playing out right now kind of as it should, that Israel will eventually, secure their borders. They will make sure that it is safe for their citizens, but they'll do it in such a way that it doesn't escalate this conflict beyond relatively small borders.
Localized, Pete, is that the word that comes up with clients again and again and again? Is there a belief that this can remain localized?
Yeah, I think that is the belief, and I think that's what the market is pricing in right now, and it's rightfully so. Israel certainly has the capacity to eliminate the threat. They said they will eliminate the threat, but I think it's very positive that they are doing this carefully and cautiously to minimize civilian casualties. The two risks kind of that aren't priced in is an escalation with Iran. It seems like we're trying to take some backdoor channels to keep that threat low, or that something spurs the change in sentiment in Saudi Arabia. Saudi Arabia has been making a ton of progress in terms of westernizing their economy, in terms of the Abraham Accords. So we're watching that very carefully. And that's probably the main reason Israel is being very cautious as well.
Pete, do you believe America has the capacity to support two military conflicts simultaneously?
We do, but as some of our generals, General Teptula has been very on top of this for a while. We have been underfunding parts of the military, so we're going to be a little bit stretched. Two fronts, I think, is fine. It does leave us a little bit vulnerable. We are going to have to see a massive replenishment of our weapon systems as we've been, providing weapons to Ukraine. It looks like we're going to help Israel in terms of refilling the Iron Dome weapons. So there's going to be a lot going on the defense side for the next years to come at this point.
When it comes to refilling all of these supplies, it does take money, and something we've been talking about. Is there an appetite to expand defense spending at a time where borrowing has gone up and interest payments are going up as well? How does that factor into your calculus at a time where a lot of people are not fully understanding some of the gyrations in the long end of the yield curve?
The one thing, so we've got the 18 retired generals, admirals, and 2 astronauts to get to work with. The unified message we get is that in terms of national security issues, DC is actually very bipartisan, very smart, right? You do not get to sit on these high-level national security committees unless you've demonstrated intelligence, bipartisanship. So I'm actually very comfortable that when we have these real threats, we will put together and do the right things. So there will be spending, it will be well done, and it's necessary. And we have to kind of reinstate our influence in the globe, which has been waning.
One thing that you do really well is you game out what is priced in and what isn't priced in. You said earlier that some sort of escalation with Iran is not being priced into the market. How would it be priced? How do you see it percolating out in the market? Should there be some sort of expansion in the region with either Iran's, some of its proxy fighters, or just the nation itself?
I think then you definitely see oil hit above 100, and more importantly, it wouldn't just be a short-term spike. I think you'd start seeing futures build out at a much higher price for a year or 2 years. And that had given us some comfort on some of these recent spikes. It was much more consolidated in the front end of the futures contract, not some of the longer-dated contracts. But if we really are going to impose sanctions on Iran, if they are going to potentially disrupt oil flow in the Middle East, that would have a much more serious impact. And I think the bond markets can kind of shake off what's currently going on. But that would probably push yields higher as we would be facing much higher oil prices for much longer.
Peter, within economics, finance, and investment, you are a student of history. Amid war, as a general rule, what do stocks do?
I think they get volatile and they're fluctuating when there's a lot of uncertainty. But once it looks like the path has come through, we generally tend to rally. I think we had that just recently with Russia and Ukraine. There's that initial fear factor. And then as people say, okay, this is what it looks like, this is how it's controlled, this is what we do about it, we can rally. And again, position was fairly light, I think, coming into this. So I'm not surprised that we can get a nice rally if we maintain the status quo and Saudi keeps making the right signals and Iran doesn't escalate this.
Yeah, I look at the catharsis required, and I'll let somebody else smarter than me determine if we've had bond catharsis. But I think we can certainly say we have not seen equity catharsis. Is that required?
You know, we saw so much equity catharsis last time around, in the last year. So I'm not sure how much catharsis there is left to have. So it's hard to get super bullish. 4,500, 4,600 in S&P seems tops. Maybe 4,200, I think, seems to be a bottom right now, unless something happens in the Middle East.
What are you hoping to hear from all of the Fed speakers? Do you think that they are that important at this point with such heightened uncertainty as we get the last gasp before the quiet period?
I think they're going to make it very clear that the data has not been consistently strong enough to hike, that they really don't want to hike. I like the fact that they're talking about real yields. We've been talking about that for a couple of months of how important that is. We are starting to see this filter into the economy. We're hearing more and more, I don't want to say horror stories, but stories of companies that were borrowing at 7% that are now facing 14% as their debt matures. So I think they're supposed to pause and let this play out, especially now with this global uncertainty.
Well, the global uncertainty is there, but then it's by straw hats and winter. What are you acquiring today? I mean, I'm assuming you're not 100% in cash, so what do you buy?
I like bonds again. We've been trying to rate range this as, we got to 480. You want to buy a lot of 10s. As you get back to 450, you sell some. Same on the stocks, right? It's kind of that range. As you start pushing towards 4,500, you want to be reducing risk on the S&P. As you get below 4,300, you want to be adding. So I think it's a trader's market. And you do want some hedges. My favorite hedges right now, I think, are buying calls on treasuries, because if we get this geopolitical escalation, although oil is going to go higher and Fed can't ignore it at the front end, I think the back end is going to start pricing in a true flight to safety trade.
Pete, how are you getting a read on the potential for escalation? If there's one particular voice you're following at the moment, whose voice is it?
There's not one particular voice. So we're searching around. And again, I've got the luxury that we've got 16 specifically generals and admirals who are retired who are talking to people across the U.S., across the world, to the IDF. So we're trying to distill this information that we get, and that's what we're trying to look for, these tiny little signals that aren't on the radar screen. So it's a little bit tricky, but I think we're trying to manage it pretty well.
Peter Tchir, managing it very well. Thanks for being with us, sir, at Academy Securities. Pete, appreciate it as always, mate.
What's really great about this is our next guest, Lisa. I said to him, what do you think? He says, I'm not coming on again until the tots are in first place. So, it's worked out well.
Well, fantastic. Congratulations. Stephen Major, Global Head of Fixed Income Research at HSBC. And really, I am so glad to speak with you. We're at a time of an incredible bond bear market. Yeah. You've been bullish. How can you reaffirm that at a time where we don't really understand why the sell-off has been so severe?
Yeah, there's been a capitulation. So there'll be people like me, but people with skin in the game, people who are actually long of bonds, who have had to cut the position. That could be for risk management considerations. It could be because clients are taking their money out and they're having to respond to that. So I think there's a capitulation. There's evidence of capitulation in the way the term premium moved. So it's the back end that's where the action is. And I think there's a lot more safety in the front end right now. You can see twos are behaving differently. Maybe for the first time this year, twos have become safe. And I think the mantra has been don't touch the twos all year, because you would have been going against the Fed. If the Fed's done now, more or less, then you're fairly safe entering twos. And that's how the bond market can start to perform better. Money will creep up from the front. That's why people are leaving the back end alone at the moment.
There's a lot there to unpack.
Yeah.
I just want to go to the whole capitulation story.
Yeah.
You said there are signs of capitulation. Where? Who is selling so aggressively at a time when a lot of people are saying it's a buyer strike?
Yeah, I think it's probably real money. And there's this game in fixed income about discussing the marginal buyer and seller. The truth is you never know till afterwards. Right? The bond market is fairly sophisticated, but you don't know the buyers until after it happened. You can see the supply coming because it's published, but you don't know who actually bought. There's a lot of gaming of who's going to buy, right? It seems to me the marginal buyer has to be domestic, so it has to be here in the US, because the official sector overseas is not sponsoring the market as it was before. The private sector isn't picking up enough, so it has to be inside here. Now, 70% of treasuries are held in the US. Of course, the Fed's a big part of that, but the story is it has to be here. It's probably not the banks. Real money has already taken long positions and may be adjusting, so it has to go into retail. It has to go to small investors. It has to go to those who are in equities, so big investors on a multi-asset basis. So people coming out of stocks into bonds, people going from cash into bonds. That's where the marginal buyer is.
The great fear here, Steve Major, is what I call the Whalen silence. Chris Whalen, with his wonderful one volume of America Financial History, where in the bond market, you're trying to do something, and all of a sudden on the other end of the phone, whether it's the 18th, 19th, 20th century, there's silence. Are we anywhere near that?
Yeah, well, that's a really good point, because it does seem that there's been a bit of a buyer's strike. And so the evidence for that is in the auctions. So you look at the cover ratios, so how many people showed up to buy the bonds at the auction. There's less there, especially in the long end, the 10 and the 30-year paper. But it gets to the point where the value is just too obvious. You've mentioned real yield several times on the show,
they pay me to do
but when the real yield is comfortably above the trend GDP rate, the actual trend GDP and the projected trend GDP, then you're pretty covered. So the inflation piece is locked. When the real yield is above the trend GDP, you're not going to go too far wrong. Now, I'm not saying that today it's free money, but it's just that you'll look back in 6 months' time and you should be happy with the investment you made today.
700 pages at the IMF, the blue book, the green book, the red book. Georgieva says she's going to print a copy just for me so I can read it. The one appendix I read was Tobias Adrian, fiscal instability, liquidity and solvency. Does Steve Major have liquidity and solvency issues as written in his appendix?
Forget the solvency. The US is going to pay its bonds. The idea that you have a ratings issue and that ratings explain the yield shift.
So what about liquidity?
Liquidity, now this is the price of getting stuff done in plain English, right? That's what liquidity is. So when the market is illiquid, it's more difficult to get a big trade done. So you have to pay a bigger bid-offer spread. That's my simplistic, plain English explanation. There is a liquidity issue right now because the banks aren't prepared to hold big inventory. The intermediaries are just not there. And liquidity and risk premium tend to move together. So if we have an illiquid market, then the risk premium goes up, and that's your term premium and the higher yield in the long end. That's what's happening right now. I look back at this and I think you've got record moves in the term premium, even back to 2013. And don't forget the context is important here, Tom and Lisa. Back in 2013, the taper tantrum was like the main thing that happened. Now you've had a 2-year bear market going into a 3-year bear market, so rates moved up a lot, then the term premium flipped. You didn't have that back in 2013. So you really are entering a good level of yield at the moment.
Given the fact that you think that we're at a good level of yield, how do you sort of lean into the front end and not the back end, right? Why aren't you just going all in on the 10-year?
Well, let me be absolutely clear. I think that investors who want to buy bonds for the first time, who are rather shy, can creep into the 2 years out of a money market product, and they're not going to lose a lot of money, if any. You're safe in the 2. So if you're shy and you're going into bonds for the first time, you're safe in 2s. Then you creep up to 3s. Right. Now, for me, if I'm making a call for the next 6 months, of course I buy 10s or 30s, because I'm going to look back in 6 months' time and think that the yield's fallen 100 basis points.
Where's it going, though, at the end of the year?
Well, our forecast is 3.5. We're running out of weeks and months, of course. Right. But 3.5 could be the right number in 6 months' time. So I don't think we've got the directional call wrong here. I think yields will be lower. It's just that maybe our timing could be off.
Yeah, it's the same as like guessing if West Ham's going to do well or not. We're running out of time. Steve Major, one final question to real yield. Joyce Chang, J.P. Morgan, on stage in Morocco, said she's modeling out a 2.5% inflation-adjusted yield. That took me back. That seeming was elevated. Take your nominal lower yield call and squeeze it into a real rate call.
Yeah, so the 2% inflation is locked. If there's one thing that's come through all of this is that inflation targeting is credible. The 2% inflation has not been challenged in the break-even forwards. So for me, it's all about real yield. 2.5 is just way above trend. Therefore, we can take 100 basis points off of that. I think that a fairer level for the real yield would be 1.5, not the 2.5 that we're trading at the moment. And by the way, that would still be above 100 over the Fed's R-star measures. So you people are saying that the real rate needs to be higher. Well, it's priced as a lot higher.
We got to go. Stephen Major joining us with the Hong Kong Shanghai Banking Corporation. We get expertise now, as we've done. Thanks to our team for really going internationally to get this done. Julie Norman is at the University College London UCL Centre on U.S. politics, but also is weaned out of a PhD program and truly one of the world's experts on terrorism. Julie, what an honor to speak to you this morning. How is this terrorism? How is this, as the president mentions, narrow stridency of Hamas? How is it different this time?
Yeah, Tom, this is a very different tactic than we see from Hamas, obviously, last weekend, and that's why the response that's being considered right now is also expected to be very different in scale, very different in tactic and operation. It also obviously has the end goal of, quote unquote, eliminating Hamas. That's, I think, going to be a difficult end game that's going to be tactically difficult over these upcoming days, weeks in Gaza. And just on a broader level, also, Hamas has a lot of regional dispersal, and they represent a certain type of resistance. And I think a lot of Israel's choices in these next few days have a lot of both moral and pragmatic implications in terms of, as we see civilian casualties rise and whatnot, that will in some ways galvanize much of what Hamas's goals have been. And I think there will be many who will step into their place. So it's a very difficult needle to thread right now. I think that's part of why we see Biden maybe considering a trip there into seeing how can Israel respond to this, but also try and avoid just a longer-term security risk.
And to play off one of your papers from a more peaceful time, Beyond Hunger Strikes, the Palestinian Prisoners Movement and Everyday Resistance. Julie, you're as close to an expert on this as we're going to get. How do you perceive a military exercise from north to south in Gaza?
Yeah. So as has been noted many times, Gaza is an extremely difficult place to live, but also to carry out a military operation. We've obviously seen already the evacuation, the movement of upwards of 1 million people from the north to the south. But there's really nowhere for people to go at this point. And so even if the operations stay mostly in the north, we're still looking at a very difficult humanitarian situation really throughout the Strip, as well as just a likely devastation of infrastructure that I think makes an end game very difficult to foresee here. We heard Biden speaking yesterday about, trying to preclude a possible reoccupation of Gaza. It's very difficult to see what governing or administration would look like in Gaza after this. And again, most of the civilians who are there are not going to have anywhere to go, and it's going to be very likely a very difficult situation for anyone stepping into that space.
It's been incredibly difficult to understand what's going on, Julie, not only because a lot of the conversations are going on behind back channel discussions, but also because of a vast slew of misinformation intentionally being put out from a number of different sides. I'm wondering, from your perspective, if you have a better sense of where the red lines are. We heard conflicting reports of Iran not wanting to get involved, then saying as soon as a ground operation starts, they're ready to go in. What have you gleaned over the weekend?
Yeah, well, you're absolutely right, Lisa. There's been a lot of misinformation, and I think all of us should be kind of careful and double checking many of the sources and whatnot. I would say in terms of Iran's movements, that I think will really be the deciding factor into if and when and how this conflict escalates. Iran has much closer ties with Hezbollah to the northern border of Israel than even to Hamas, and I think it's really the question of if they would activate Hezbollah, open up a northern front that would really change the contours of this war and make it a much more of a regional conflict. We are not at that point yet. Obviously, Secretary of State Blinken has been on a massive diplomacy run through the Arab world this week to try and deter Iran or Hezbollah or their proxies from further escalating this. But I think that's not a given, and that's one reason, again, why these conversations are going to keep continuing to see, okay, there's the operation on the ground, but also what can we be doing simultaneously to try and deter other actors, and especially Iran or Hezbollah, from getting involved even further.
It's a tragedy, and we all are seeing the tragedy unfold, a humanitarian tragedy on both Israeli families as well as in Gaza with people fleeing the north. I'm curious why, if we're hearing that there are 100 trucks backed up, ready to deliver humanitarian aid to Gazans that have gone south, why they're not being let through.
Yeah, so my understanding on this is that Israel wants to be able to check any of the trucks that are coming through for security reasons. So they will not give a guarantee that some of those trucks would not potentially be that they would not be immune from targeting and whatnot. So that's where the impasse seems to be. There is a lot of aid waiting on the other side of the border to come in. There are a lot of people in need waiting to come out. And I think where a lot of Blinken and Biden's conversations with Israel will be is trying to negotiate some kind of opening on that border to allow that passage.
Professor Norman, we're all falling back on our memories on this and our knowledge. If you look at the present day horror, and you look at Albert Harani's History of the Arabs People, or Fromkin's A Peace to End All Peace, are we now beyond the chain and linkage out of World War II of the Levant? Are we onto something new here?
I think we are, Tom, and this has been obviously coming for a while. This is a broader regional question. I think the Arab uprisings, the Arab Spring that we saw 10 years ago, many thought that would be a new direction. Those went a slightly different direction than many hoped or thought they would. But we are seeing now, I think, is a resetting. And again, a lot of this is in a context of, steps forward and steps back. I think there was a lot of hope this year around some normalization between Arab states and Israel, and many see this attack as trying to be a spoiler to that, which it obviously has been. So there's been again a lot of shifts in this region, and I think this war will be very definitive of where the region goes after this.
Judy Norman of UCL. Judy, thank you as always.
Joining us now to save the show, Erika Najarian, large cap banks and consumer finance equity research analyst at UBS. She is not wearing a cast on one of her ankles this morning. Erika,
how do you know?
I did. Thank you. I look, Erika, at where we are right now, and if I look at the Keefe Bruyette Index, we're down 48% from the nirvana that we did in 2022-21, and we've only got 26% down to go on a blended bank basis to get to COVID lows. What do they do to turn the ship around?
So it's pretty simple. And I think that they essentially have to disprove the negative, which is that higher rates is only bad for banks, or higher rates are only bad for banks. As you could see in the earnings results so far, that's not actually the case. A lot of these banks have the raw material to make more money in a higher interest rate environment, which is a good deposit base. But what we've seen early this year with the 3 bank failures is the dark side to higher rates. What happens when you're offsides and rates go up faster than you think? And so what the market really needs to see is you're not seeing massive capital losses, you're seeing deposit stability, and you're seeing net interest income progress in the right direction as they earn more on their assets and their liabilities.
I mean, correct me if I'm wrong, but Erika, the history to me is called synergies or cost cuts or moving things. Are they to the bone now where they can't cut anymore? Are they going to choose which divisions to participate in into 2024? Or is it just going to be, cut 4%, let's go?
That might not be the right question to ask unless it's someone like Citigroup that has a very specific expense cutting plan. Keep in mind that these banks are actually making a lot of money right now. They're making a lot more in net interest income than they did last year. Trading has been resilient. Investment banking is cyclically depressed, but could bounce back. And so a lot of these banks understand that you can't necessarily cut your way to glory. And so while we think they're going to be mindful of expense growth next year, I think that the question really is how do they think about revenue resilience next year? How do they, maintain deposit costs at a certain level if the Fed does pause in order to enjoy fixed asset repricing? I think the question is more about keeping deposit costs, or rather keeping operating costs at a lower growth rate than revenue growth, rather than outright expense cuts at this point.
Erika, they're making bank, let's be honest, right? They just had a record quarter, as Jon was mentioning, for net interest income. If they are doing so well and they have surprised the upside and they're not putting as much to the side to cover loan losses as many people expected, why aren't the shares doing better?
Because a lot of investors are still really fearful of what could be the consequence of higher rates, and the rapid increase in rates, which is a recession. And at the end of the day, a lot of these banks are, like you say, making bank from a revenue perspective, especially on net interest income. But a lot of investors are fearful that we'll see higher credit losses, whether it's on the commercial real estate books or, corporate books, or, the consumer weakening. So right now, the valuations are staying cheap because a lot of investors are essentially saying, well, I'm going to wait till I really understand the complexion of the downturn before I really step in and, really call these stocks inexpensive.
So how much are you getting pushback? How much are you recommending to investors to buy certain bank stocks and making the argument they're undervalued because of this uncertainty, and yet they're increasingly acting like utilities because of how much capital they've put aside and how regulated they've become?
Look, I think the reality is that the banks are in a little bit of a trading range at this point. So, you brought up 2 points. One is macro and one is regulation. Near term, we do think that the rubber band has stretched a little bit too far and they're at the low end of their trading range. And they are a little bit too inexpensive, relative to the reality of their earnings power today. That being said, you bring up a good point. Not only is the uncertainty over the economy really tamping down what their multiples could be, right? But also you have a lot of new rules that are coming down the pipeline. That being said, I like to describe the new rules in terms of what's coming down the pipeline as tough, but not nearly as, game changing as it was coming out of the financial crisis. If for money center banks, the regulatory landscape went from 0 to 10. I feel like Basel III Endgame and the upcoming liquidity rules, it's going from 10 to 12. And perhaps from regional banks, it's going from 8 to 11.5. But either way, I think what I'm recommending to investors is, look, take advantage of these prices at the low end of the trading range, but valuations are not really going to be able to re-rate meaningfully to normal levels relative to the broad market until we get more certainty, more clarity on what the economy looks like over the next 12 months.
Erika, good to hear from you again. Let's do it again soon. Erika Najarian there of UBS.
For anybody linked into his valuable Twitter account, it has been a visceral and direct week for Douglas Kass with family members and business associates in Israel. Doug, to take a broader view on this and a less personal view, you are a nerd with the heritage of Israel from 1948 to what I remember in 67 and 73. I don't see how we prosecute forward, whatever anyone's view, with the immediacy of the media today, the immediacy of social media and the rest. How would you suggest, with the damage your friends and your family have had over the last week, how does this war progress with the immediacy of the modern media?
It's a heavy weight. To me, the most astonishing thing is that the Spiders closed at under 4:30 on Friday, the day before the Hamas attack on Israel. It's now trading at 4:33, and we can add during the interim interval some unpleasant PPI and CPI releases. The market's extraordinarily resilient. Look, I admire people that are confident in view, but I don't see, and I've said this to you and Jon and Paul for about 18 months, I don't see a backdrop that can make one confident either being excessively bearish, like Morgan Stanley's Mike Wilson or J.P. Morgan's Marco, or excessively bullish, like most of the commentators on the Death Star or Tom Lee at Fundstrat. To me, the range of outcomes, as we've witnessed 9 days ago in Israel, is wide, and the events are unexpected. So the question really is, what does a hedge fund manager do to deliver superior investment returns?
How do you filter geopolitics? If we go back to the desk at Kidder Peabody and you're doing sell-side security analysis, I mean, you know, we're too young to go back to Vietnam, but the answer is, how does Doug Kass filter geopolitics, or do you observe it while you're discrete and separate in investment?
I think it builds in, Sir Thomas, a degree of uncertainty that it suggests that, at least to us, the clear ramifications is that the recent events support the message that I just said, that it underscores why you should be managing your capital conservatively. And unfortunately, without the confidence that is typical, and you superimpose that with what Howard Marks has called a sea change, specifically as it relates to higher interest rates, that the fundamental investment environment has been altered. You don't assume the investment strategies that have served you best since 2009 will do so in the years ahead. Most hedge fund managers have really sought beta, leveraged long portfolios in the last 14 years. I think it's time to seek alpha and to develop strategies perhaps more like, and we invoke, of course, Alfred Winslow Jones, the father of the hedged fund industry, who ran a true long-short book, and that's what we do. Unlike most hedge funds.
This is, yeah, I don't mean to interrupt, Paul. I want you to jump in here, but what Mr. Kass just said, folks, for those of you who aren't sophisticates, is absolutely critical, and that people in the fancy world are talking long short, but they're really not. They're not taking J&J against pick a stock Pfizer or whatever. They're not.
Long short guys, basically, Paul, in the last 14 years have been leveraged long.
Yep.
You know, I am very comfortable on the short side at Seabreeze. Short selling requires or mandates a degree of creativity. It's time consumptive. It requires a lot of primary research because the sell research staffs are geared towards longs. And importantly, as I've often discussed in my past lectures in Dr. Schiller's course in Yale School of Management, short selling mandates strong risk management skills.
Like you'd want to go, Paul, long Diamondbacks, short Dodgers, just to give an example.
Exactly.
Well, what you want to do in fantasy baseball is be long Kershaw and Verlander and short everyone else. But where we've moved from being net short to being market neutral on the decline right before Hamas. But there's so many great opportunities because people aren't really dealing in selecting stocks. They're making broad market decisions. Right. Like for vet bill, your two vet bills and my two can be long fresh pet and short Petco.
20 minutes, Paul, before this dance. Mrs. Keene sent me an email. The two of them are set up for dog grooming.
Sure.
Mayor Adams' team just emailed me. He wanted to call and thank me for moving the needle on New York City GDP.
Economy. So, Doug, I mean, as you think about geopolitical risk, it's just one of the many things that investors have to deal with. Are we kind of in a new normal now? Because it feels like, at least in the Middle East, we're going to have a number of years where it's just going to be very unstable. And I'm not even sure about Europe, but certainly in the Middle East.
Right. Look, we start by saying that on a historical basis, valuations are elevated. And we remain of the view that credit is more, it's not just the Mideast. Credit is more attractive than equities. Slugflation lies ahead, sluggish growth, prickly inflation. Political and geopolitical problems are intensifying. I mean, the lack of partisanship and fiscal discipline reminds me of that sketch with Laurel and Hardy, that's another fine mess we're in.
Right.
Interest rates are going to be higher for much longer. Earnings per share expectations of high single-digit, low double-digit growth next year. I was listening to Jay at TPW Pulaski, and I mentioned that my grandma Halifax had a phrase about his optimism, but I can't repeat it on the radio. The upbeat economic forecasts within the context of rising real interest rates seem fanciful to us. That U.S. dollar strength portends corporate profit vulnerability. I think it's important to recognize that we're moving away from globalization and towards nationalizations for obvious reasons. It holds a future of lower than expected corporate profit and margins, as well as producing more inflationary impulses. Finally, the yields available in fixed income, the one-year Treasury bill yields 5.4%. That's an equity-like return with little volatility of risk, and risk premium is paper thin and at multi-decades low. I think that the S&P dividend yield is only 1.62%. That compares to the one-year yield of 5.4%. And now we're getting the same old crap that we got in 2021, the end of 2021. Market leadership is narrowing. But there are a lot of stocks now that are starting to make new lows, that are starting to be attractive away from the Magnificent Seven on a reward versus risk opportunity. So we expect to see change,
right.
and we believe that the successful strategies of being net long since the great financial crisis is not the desirable strategy.
Yeah. Doug, we're out of time, but Paul Sweeney and I say thank you to you for your wisdom here on the market, right or wrong, and also a heartfelt thank you to your reporting of your family and your business associates from Israel. It's really been of immense value. Douglas Kass with Seabreeze Partners. Subscribe to the Bloomberg Surveillance Podcast on Apple, Spotify, and anywhere else you get your podcasts. Listen live every weekday starting at 7 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can watch us live on Bloomberg Television and always on the Bloomberg Terminal. Thanks for listening. I'm Tom Keene, and this is Bloomberg.